2024 has been a pretty good year for the stock market, where the S&P 500 has reached all-time highs, and also many major indices also had some pretty huge year-over-year percent growth. And I like to make it at least a once-a-year exercise to review my investment strategy going into the new year, just in case I want to change anything. So in this video, I'll be sharing my investment plan for 2025. Now here are some investing basics that I like to keep in mind. I grew up pretty poor, and I come from a lower income class family. And at that tax bracket, there are no financial advisors or anyone teaching you about investing or investing in your 401ks, or even in the stock market. So most of it you just pick up along the way on your own, while making a lot of mistakes along the way. But mistakes really do help you learn best, and luckily I majored in business for undergrad and then went for my MBA, and a big part of what everyone wants to talk about are all business related things. So that's finances, investing, entrepreneurship, and naturally in that field, it really accelerates your business and finance acumen. Now, I focus on investing and not on gambling. If you ever watch those I'm 18 or I'm 10 and I have $500,000 net worth videos, do they make you want to sit down properly and invest in your 401k or maybe an index fund and then wait the next 30 years before it pays off? Or are they more likely to make you want to time the market and pick the next big stock, have a portfolio of 100% in cryptocurrency, and spend your paycheck on lotto tickets in hopes that you get rich in the next few months? This also extends to forums like Wall Street Bets and the phenomenon known as meme stocks, or even finance news that are telling you to buy into the next big thing. And for me, I really do understand the allure, because who wouldn't want to be the lucky person who had bought Bitcoin long ago and throws yacht parties every day now? Or be the person who bought into Palantir early on at the lowest and then sold it at its peak? They make it sound so easy and you get to thinking that you could be the next lucky one, or maybe it's not that hard and that you will be the next lucky one. And now even finance news, you probably want to be wary, because how often are they actually right? And what do they know that you don't? And if you followed their advice before, are they more likely to steer you to riches or not? And in my experience, finance news isn't actually all that helpful when it comes to stocks. And some word around the block is that they're in cahoots with the ultra rich. And with how big the wealth transfer during the start of the pandemic was, from the masses over to the billionaires, they might actually have something there. With that being said, these are some key things to keep in mind for 2025. Now, whether you're an ETF investor or you like individual stock picking, while nothing is set in stone, with a Donald Trump presidency, a few things that he's discussed is that he wants to reduce taxes for individuals and corporations, fight inflation, and also impose tariffs. Now, at a high level, reduced taxes and lowering inflation can encourage consumer and corporate spending, which can serve as a boost to the US economy. For corporations, it can also improve their financial and corporate earnings, which can boost up their stock price. There can also be an additional effect depending on whether consumers believe that the reduced taxes will be longer term or short lived, but both can still boost up the US economy. However, reduced taxes can also increase the federal deficit. Now, tariffs. These can cause higher prices, which can overall reduce consumer spending. Sectors such as technology, automotive, and retail could definitely feel it because of their heavy reliance on international supply chains. However, on the opposite end, domestic industries that have traditionally competed with foreign industries may actually see benefits. Now, interest rates. The Federal Reserve has said that they are planning to keep rates steady after their most recent cuts. But that can always change and it's not set in stone. Higher rates can discourage borrowing and ultimately discourage spending. Lower rates means the opposite. Now, with those things out of the way, I am a long-term investor, meaning I'm a pretty boring investor and my portfolio largely remains the same year over year. And I'm mostly an ETFs person, where the majority of my portfolio is in the major indices. The remainder is in crypto, just to satisfy the gambler's urge and ambition in me, some in individual stocks, and the remainder in cash, mostly via a high-yield savings account, which is for other purchases or other investments. But when I first started, I used to mostly dabble in individual stock picking, which sometimes had great results. For example, I bought AMD when it was just a few dollars each, and sometimes it had horrible results. But I've largely moved to being a long-term investor, which frees up a lot of my time to work on building my businesses and working on actively growing my wealth on that front. And with most major indices reaching all-time highs, ETF investing has especially worked well for me in the past year. Though I may actually buy more in downturns and crashes, so I get those nice discounts and deals. Now, there's no guarantee that these ETFs will ever rise back if they've fallen, but given its long history of falling and going up and down all the time, and then eventually reaching higher than it's ever done before, it keeps me feeling optimistic. So my primary strategy is to continue dollar cost averaging and to keep up my regular contributions into my retirement accounts. The main vehicles we have for retirement accounts in the US are the 401k, your IRA, or things like the 403b if you work in nonprofit, and etc. So I know that was a quick video, but thanks for watching and please subscribe.